Welcome back to our channel, where we break down complex financial concepts into simple, easy to understand explanations. Today, we will be diving into key features of two critical instruments in international trade finance: demand guarantees and standby letter of credit. Both are essential tools that provide security in transactions, but they can often be misunderstood. So, if you are new to the world of guarantees and letter of credit, or you just want to brush up on your knowledge, you are in the right place. Let's get started. What are demand guarantees and standby letter of credit? To begin with, a demand guarantee is an irrevocable and independent undertaking issued by a guarantor. This obligates the guarantor to pay the beneficiary a specific sum, which is up to a preset maximum, if the beneficiary presents a demand in documentary form that complies with the terms of the guarantee. Similarly, standby letter of credit works in much the same way. It is an irrevocable undertaking by the issuer to pay the beneficiary again upon receiving a compliant documentary demand. Both of these instruments serve as financial safety net in case one party defaults, making them incredibly important in international trade and project financing. The importance of written and signed instruments. A key point to remember is that both demand guarantees and standby letter of credit must be in writing, either on paper or electronically. If on paper, they need to be signed. If electronic, the issuer's identity must be authenticated. Often SWIFT messages are used for secure transmission. However, it is crucial to note that a fax or a PDF copy won't be always suffice unless accompanied by an original signed document. Key features of a demand guarantee and standby letter of credit. Now let's explore the primary features that define these instruments. These features apply equally to both demand guarantees and standby letter of credit. So we will refer them simply as instruments. First one, irrevocability. The instrument is irrevocable from the moment it is issued. Second one, independence. It is independent of the underlying transaction or relationship between the parties. Third, documentary demands. The demand for payment must be made in documentary form. There is no exception for that. No non-documentary conditions. The instrument should avoid any non-documentary conditions to keep the process smooth and manageable for the issuing bank. Fifth one, monetary limit. The instrument must have a clear maximum amount that can be claimed. 6. Fixed duration. Most instruments come with fixed expiry date or an expiry event, but there are often mechanisms for extensions as well. Clear terms and condition. All terms must be set out explicitly in the instrument or in the rules incorporated in the agreement. 8. There should be an identified beneficiary. Only the named beneficiary is entitled to payment under the instrument. Rights cannot be transferred without express permission. So, if you are already familiar with commercial documentary letter of credit, these features will feel very similar. Let's see them in detail. Irrevocable undertaking. One of the most critical aspects of both demand guarantees and standby letter of credit is that they are irrevocable. This is particularly important because the beneficiary must have confidence that the instrument provides effective security in case of default. Even if the instrument does not explicitly state that it is irrevocable, in most cases it will be treated as such unless otherwise indicated. When does it become effective? The instrument is effective at the moment it leaves the control of the guarantor, even if it hasn't reached the beneficiary yet. This is legally binding in many jurisdictions as an exception to normal contract rules. The principle of independence. The cornerstone of both demand guarantees and standby letter of credit is the principle of independence. What does this mean? Well, the issuer's obligation to pay is completely independent of the underlying transaction. The issuer is obliged to pay as long as the required documents are presented. Even if the applicant, that means the party who requested the guarantee, has defaulted. The independence means that the issuer only need to verify that the presented document meet the terms and conditions of the instrument. Issues like force majeure, commercial dispute, or even the applicant's bankruptcy do not affect the obligation to pay. Documentary demands. This principle extends further into how payments are made. Banks, for example, only deal with documents, not with goods or services related to the transaction. Here how it works. The beneficiary must submit a written document along with any other required documents outlined in the instrument. The bank will only check the documents for compliance with the terms, not the actual completion or quality of the underlying work. This documentary nature simplifies the process and speed up the transaction, as the bank is not required to investigate the underlying relationship. Avoiding non-documentary conditions. Given that bank only deal with documents, it follows that the instructions should not contain non-documentary conditions. If the instruments contain conditions that are not tied up with documents, this can cause unnecessary complications. For example, if a payment guarantee requires that a specific stage of the construction project has completed but does not require a proof of completion through documents, the bank wouldn't know when to release funds. To avoid this, all conditions must be linked to a documentary proof. Monetary limit and fixed duration. Every demand guarantee or standby letter of credit include a fixed monetary limit. The beneficiary may make a single demand or multiple demands as long as total does not exceed that limit. In some industries like energy, price fluctuations might be addressed by including a clause that adjusts the maximum amount based on the market indices. These instruments also usually have a fixed duration, often with a clear expiry date or event. Some standby letter of credit even include an evergreen clause for automatic extension unless the issuer gives notice of termination. Finally, the instrument is issued to a specific beneficiary. While bill of exchange or promissory notes are transferable, demand guarantees and standby letter of credit generally are not, unless expressly allowed. So, demand guarantees and standby letter of credit are crucial tools in finance, providing security and certainty in business transactions. Remember, their key features. First one, irrevocability. Second, independence. Third, documentary demands. Fourth, clear terms. Understanding these concepts will help you navigate the world of international trade finance with confidence. If you found this video useful, don't forget to hit that like button and subscribe to our channel for more financial insights. Thank you for watching and see you in the next time.